Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, June the 2nd. My name's Eric Wilkinson, and some of you very well may recognize me as the Wolfman, where I've talked about everything from the economic and geopolitical environments and how that impacts the overall markets. Well, I do the same thing in these daily market commentaries, but I layer on top of it some option strategies that I find to implement into my portfolio based on what I've got going on over there in that trading account. Also, please remember past performance of any trading system or methodology is not necessarily indicative of future results. All right, we brush on some of these different guidelines that I have, this roadmap that we're trying to build here on trying to find the right option strategy for the right environment, how we use these options to increase that overall yield in our portfolio. Well, I do talk about in more detail in my webinars these different option strategies and what we need to go through our process in order to find the right strategy for the right market assumption, okay? Or for our market assumption, I should say. Without further ado, let's get on with the economic data and start talking about how that's impacting the overall market. Well, we got a couple more manufacturing PMIs from across the pond, but those aren't the most robust numbers that we like to see there. We did see out of Great Britain mortgage approvals coming in a lot lower than expected, 16,000 versus 34,000, and 34,000 is pretty weak anyway for a guesstimate. And then over here in the United States, we have Ward's total vehicle sales, which is going to be something to keep an eye on. Now, if you remember way back when we started this whole coronavirus, I was on the bandwagon of buying different, or actually selling puts and having that stuff put to me, but getting long different companies that I thought would do very well in a corona type environment. That being said, Airbnb was not one of them. Airlines were not one of them, even though I did try to take advantage of some low prices in the airlines. That didn't work out so well. But I did talk about Thor Industries, which creates those great big huge RVs and the pull behinds and the pop-ups, okay? That company has done very well. I also talked about Microsoft and how people were going to build out their home theater or their home offices in order to work from home. I also talked about how Uber and Lyft were probably, these ride shares were probably not going to do very well, because who wants to get into a car where you don't know who was just in there, right? They aren't cleaning those things out all the time. And that people might go back to buying more cars. So we'll have to see how that's working out. I think it might still be a little bit early to see that kind of spike start to happen. But as people are going back to work or getting back out of this lockdown, we could start seeing more and more people out shopping for cars. So we'll have to see how that's starting to get impacted. It is expected to be a little bit higher than it was the previous month. So, but that comes out all day, and we won't get that until probably very close to the end of the day. Just keep an eye on Phil LeBeau. He's the one that really is the one that does the best job, as far as I'm concerned, on keeping track of all of that. All right, crude oil moving a little bit higher today, trying to debunk my theory that 30s is a little bit overdone to the upside. We still are not seeing a whole lot of demand for crude oil. We are going to be getting out a crude oil inventories later on this week, so we'll have to keep an eye out to see if there is actually some more demand creeping up for crude oil. But right now we are seeing a spike happen here. As a matter of fact, I went and filled up my tank, and it is very close to back to being $2 a gallon at the pump. That was at Costco though, so that's a little bit cheaper than most places. Anyway, crude oil is starting to make a move. We get much higher than this, it is looking like that 40 handle is going to be a sure thing, because it's going to look like we are going to want to go up and cover the gap that we've created on the downside when all of this pandemic started. So as we can see here, there is a gap right in line with that, and we're touching the bottom end of that as of right now. So we get much higher than that. That's why I'm talking about we might get that little bit of pop to cover the gap that we've created right here. So that is something that is going to be key. Markets love to cover those gaps. To me, 40s seems a little bit rich. even though we're seeing some cutbacks and things of that nature, it just seems a little bit rich, and doesn't seem like that many people are getting out as of right now. So we'll see. The market can stay irrational longer than we can stay solvent. All right. Gold coming off a bit today by about $15 again. We are still in a range where I've talked about basically from 1787 right there to 1658. Those are the areas of interest here in the market. I think that we're going to see the market kind of trade back and forth, build out a bit of more of a volume node in and around that area, at least for the foreseeable future. I don't see us really making a spike up into that 1800 handle. Everybody else in the world is trying to devalue their currency as well as the United States, and that's really the precipice of driving that higher, and I don't see the inflation anywhere soon. So that would be another thing that would cause that to drive, but there just doesn't seem to be any inflation right now, especially with crude oil prices lower. We're not really seeing food prices spike that much, despite the fact that we're seeing some supply chain disruptions and things of that nature. Not really seeing a massive spike in those prices for food. Bonds, we're down there at that 177 handle. I've talked about this 177-ish going into the 176 handle. That 177, I believe, is going to be support and defended quite dramatically. The Fed might even come in and help defend that area to keep interest rates suppressed. I think that we're going to stay still within that 183, 177 unless something crazy happens. I don't see interest rates needing to rise, especially when we just saw Amazon release a bond today at 0.4%. So when companies are able to loan out at that seriously low level, the Fed has got to be able to issuing at lower suppressed levels as well. I think that was a 10-year bond, but still, I think that was a record for a company being able to issue a bond or something like that where it was that low. All right, VIX coming off a little bit. We got a bit of a mixed bag here where we've got the Dow Jones Industrial Average moving higher by about 128 points. And it's still kind of that sector rotation. Every once in a while it gets a little jiggy, but I've talked about this. We've seen the Nasdaq really blast off here with a lot of these tech companies that I've talked about are going to do well in this coronavirus. So that's not too surprising. But what we are seeing is that those prices are above, in at least some of those stocks in the Nasdaq, above where we were before all of this pandemic came out. Now, are they still on pace to do as well as what we earlier expected? I doubt it. So I think that a lot of investors are in the same boat as me, as, hey, it might be time to pare back some of these stocks that have done very well, sector rotate into some of these stocks that have been lagging a little bit, like the blue chips. IBM is, in my eyes, is a perfect example. I haven't rolled into that yet, but I am very close to getting into some IBM because, remember, I've done webinars, or actually not webinars, I've done earnings trades on IBM and talked about it in these daily market commentaries where IBM is being chastised for switching from being a service company into being cloud-based, which is a higher margin, lower labor intensive type of business structure. The mainstream Wall Street doesn't really, Wall Street or Main Street doesn't really like that about IBM. And I've been saying that is what is going to be good for IBM. And it's been still dragging. And I think that once they start showing people that this is the new business model and they're doing very well with it, that it could pop. So I am looking at IBM to implement something into my portfolio with IBM. All right, so that's moving higher there. We've got the Nasdaq, like I said, a mixed bag, off a little bit today. And again, we are above the yearly highs, as we can just go back to 2020 and see that we are well above where we were coming into 2020 and right before, almost to where we were before this coronavirus. E-mini S&Ps are moving a little bit higher today, but again, we're getting a little overextended here in E-mini S&Ps. I do think that this magnet at 3,000 is going to be something that really kind of pulls the E-mini S&Ps, keeps them from rallying. It's a really quiet day over there at the SPOOs. So I think that the market's starting to lose a little momentum here and is going to want to kind of hang out at this area somewhere between 3,100 offer and about 2,900. All right, so that's what I'm looking for in the E-mini S&Ps. You can see here, overnight inventory got very long, but they got flat pretty much coming into the day without any economic data. It is all news driven, and the news right now isn't that great. So you could see that that's kind of like a bit of a gray cloud hanging over us right now. But we're trying to get some momentum to the upside here. It just seems to be like the bears come in and are giving it a bit of a smackdown, causing that pressure to the downside. All right, E-mini S&P, or sorry, Electronic Arts, EA Sports is what I always call it because that's the first thing that comes to mind for me. Remember, I got long this stock at 89 by selling some puts in there during this whole pullback. It was one of those stocks that I said is going to do very well during this coronavirus. I even talked about it on one of these daily market commentaries where I asked my kid, hey, how's the EA Sports doing? And he was, or how much money are you spending, I should say, in EA Sports? And he was like, I'm spending a lot of money, Dad. So that shows me that things like this, where kids are sitting at home playing these games, are spending money. It's not like back in the day when I was playing it, you'd go out and you'd buy a cartridge and you were done. Now it's you buy the game and then there's all of these in-game upgrades where you can buy different types of cards and it's pay to play. And how well you can build your team is basically how much money you can throw at it. Well, EA Sports obviously benefiting from that and making a nice move higher. But again, people saying, all right, have we gotten ahead of ourselves? This is something that maybe I want to trim back in my portfolio. So you can see that we are starting to get a bit of a pullback here. Now, something that I want to talk about here is a lot of times in past webinars I've talked about where it could be a continuation pattern when you see like a doji like this after having a big move higher, right? So we're in a bullish trend in a sense and the market starts moving higher there. Well, what happens when you get a counter-opposing doji like this, which is what we've seen over here right now, or we've kind of got that set up? Well, today, usually, it is, and I've said it time and time again, we don't know when you get this type of setup right here what is going on, because the market could signal a continuation pattern or it could signal a top. You have to wait for the confirmation. To me, now with this bar happening in EA Sports that we're seeing right there, it is looking a little toppy. We're going to probably see a pullback, maybe down in and around 117.5 is kind of my thinking, and that comes about because we have the little sorry, they're not a very good line there, but basically we've got a volume node right there. So that to me seems like the most likely place to come down and test. If we are going to make a bit of a correction, I think that it could probably hold there. I haven't added anything to this position, but if you remember on this rally, I've done a lot of things in this portfolio. Originally, I sold the 89 puts in there, the 89 puts, which got put to me. I was happy about that. The market started rallying, and I felt like I missed out on quite a bit of this move here. So if you remember when we were doing the webinars, I was talking about the ratio call spread where I went in this trade here and did the May and bought the 115 calls in there for every 2 of the 120 calls I sold. And I did that for a collection of 62 cents. Now, what does that do? Well, I'm long at 89. I was talking about I'd be happy to cover some of these calls or some of these longs that I have on at 120. That basically was breaking above the yearly high there, or that 52-week high at the time. So I was wanting to take advantage of some more upside. I didn't necessarily want to go out there and buy calls or even sell puts, which was probably more likely the right strategy for that high implied volatility. Or we could do this ratio call spread where I'm still taking advantage of the high implied volatility. That worked out great. Why? Because the market rallied up, tested those 120s. Those 120 calls settled worthless, but it was just slightly above 115 at that time, and I got the stock put to me. Or I called away the stock, actually, because I was long the calls. I called away the stocks from somebody, and was able to capitalize on a better move higher. Once we went back up and tested 120, I covered about half of my position in there. Then what did I do? I flipped over and started selling some more puts in there, and I sold the June 105, the 105 puts in there for 64 cents. Well, I bought those back today for 24 cents. So all in all, lowered my overall cost basis on these stock that I'm long by 40 cents. Okay, so I covered those puts. Yes, I still am liking EA Sports to the upside, but with this bit of a correction, or this is what looking like we could get a bit of a correction here, I wanted to cover that put trade. If we pull back again, I'll probably add some more puts in there, some more short puts for dollar cost averaging purposes. But just wanted to keep you guys on track with that, what I'm doing, how I'm staying mechanical with this overall trade, and how we do this in a portfolio. So these are some of the things that I talk about when we're implementing options into our strategy. That was the whole course that we just got done with. I've gone through all of the strategies on building out a portfolio using options and how we do that, right? We start selling puts, we cover the calls, lower the overall cost basis, they get called away, we start selling some puts, add some more to our portfolio, and continuously do that. That is the only way to really increase that overall yield in your portfolio. So check out implementations of options into your portfolio, because that is where you are going to find how to build a long-term portfolio and how you manage that portfolio going forward by staying mechanical. All right, enough about that. All right, one other thing we got to talk about here is let's check out this real quick. I got to talk about the disclaimer here. Make sure that you know that there are risks of losing money while trading. Another thing I want to also talk about while you're going over this is this upcoming webinar. We're going to be talking about the roadmap to building out option strategies. I'm coming up with a bit of a different thought process that will help you maybe remember how, when, where, and why we would implement any one of these given option strategies, and some of the guidelines that I use in order to do that going forward. All right, so check that out. Go to protraderstrategies.com. That's all I got for you today, other than if you can't take that, take it easy.